Hello, everyone, and welcome back to another episode, which is brought to you by Moose Investment Research. Today, we're going to talk about the economy, the Fed, the increasing interest rates and high rate of inflation that everybody's been talking about. I think it's important because it affects almost every household, and not just in the US, but all over the world. We also have a special guest today, Amrita Roy. She's joining us from Vancouver. She is a macroeconomic analyst who also manages her own private fund. She writes regularly on Substack, releasing 3 newsletters on a weekly basis, which go by the name Pragmatic Optimist. Optimistic, she is always about the economy. So she writes about the economy, she writes about the markets and geopolitics, and also investment opportunities, especially in the technology sector, given her background. She's been involved in 2 tech startups in Silicon Valley. She has an undergrad degree in physics at Bates College and an MBA from University of Rochester's Simon Business School. I've always had a lot of fun reading her newsletters as she shares some valuable insights on various industries. She also talks about investment opportunities, as I said, especially in the defense and tech industry. So, Amrita, welcome to our channel. I'm delighted to have you today. Why don't you just give us a little bit of background about yourself, and then perhaps we can move on to our Q&A session and our discussion today about the economy.
Sure. Great to be here. Thank you very much. I think you've already introduced me very well enough. But once again, I'm Amrita. I write for the Pragmatic Optimist. It's a newsletter I started about 3 months ago, where the core focus is to connect the dots in macroeconomics, tech, and sort of broad trends in culture and society, using data and frameworks to identify great businesses, to build perspectives with clarity, and to just improve our overall mental and financial well-being. Prior to this, over the last 3 years, I managed a small family fund under the name of Project M, where I look at sort of the structural forces driving the narrative today in the economy globally and beyond, and invest in specific opportunities that are best positioned to take advantage, to either enable or take advantage of those structural trends moving forward. And as you said, prior to that, I had spent most of my life working in tech in the Silicon Valley and some other projects prior to that. But yeah, that's me. I don't come from a traditional finance and macroeconomics background, but it has been sort of a deep sort of a passion for me to understand how the world works, how the mechanics of all the different forces work. And that's why I spent the last 3 years sort of, deep diving into myself. And here I am.
Okay. So thanks for the introduction, Amrita. So I want to start off with the recent economic data that you shared in one of your recent articles. I know you have written extensively about this. So I want to get a sense of where we are today in terms of the overall health of the economy in the US, and what are some of the macroeconomic challenges or the risks that you see today in the US economy?
Sure. So I think you sort of asked 2 questions over here. One is sort of the state of the current economy, and then the risks that are emerging, and I'll address each one of them separately. So the first part is the current state of the US economy. As we are all aware, the Fed has hiked interest rates 11 times from its first time in March 2022 to now. This has been one of the fastest and most aggressive rate hikes since the Volcker era, and they did it in order to quell inflation, which had also climbed to one of its highest levels since the Volcker era. At the same time, the Fed also reduced its balance sheet size from $8.5 trillion to like $7.5 trillion. That is where it currently sits. What the Fed had done during the COVID pandemic was it had doubled its size of the balance sheet. Obviously, this tightening was done with the overall idea to quell inflation. And has it been able to do that? But yes, it has been. Inflation has come down from its peak to currently at around 3.5% core inflation, which is a good sign. We are seeing inflation trend down. That is what we want to see. The Fed's long-term target is 2.2%. So we want to see it trend down, and we are seeing that. Brilliant. So far, the things that have held up really well. despite the overall tightening of the economy, is that consumer spending, which was, again, like roaring during the COVID pandemic, driven by excessive, or I mean, if excessive is probably a relative word, but driven by COVID stimulus packages, that kind of excessive spending has come down. It is still trending higher, though, from pre-pandemic levels at 5.3%. Consumers had piled up excess amount of savings that is drawn down to quite a lot at this point. Consumers, especially lower and middle income households, have tapped into consumer credit card debt. So that is on sort of the more consumer side of the story. Plus, if I add on the housing aspect of it, housing market, which was originally kind of, we were all thinking that, oh my God, it's going to go down, it's going to decline, it's going to sort of almost see a mini 2008 crisis situation, actually did not happen, because in a way, obviously we know the existing home market is 70% of the market, and existing home market has held up pretty well because people who are homeowners of existing homeowners have refinanced their debt at like very low interest rates. They are not moving out. And as a result, existing home prices have stayed steady and even growing. In the meantime, obviously, we are seeing housing affordability as a whole being challenging. And we can talk about housing as a separate topic if that is relevant. But I just wanted to bring it up because housing is 33% of overall consumer spending. So that's on the consumer end. On the corporate end, we have seen sort of like the companies that have been able to restructure their finances in a way that they also had refinanced their debt at like low rates. They actually did not see their interest expenses rise at all during this period of time, despite the Fed raising interest rates. In the meantime, they actually saw an increase in net interest income. So you see like the likes of like Microsoft and the Facebooks and things like that. And you were wondering like, why didn't it collapse and remain sort of at subdued levels? And yet they're reaching all-time highs, primarily because their net income is boosted by the net interest income. So while there has been like some tightening and we have seen like some slowdown, at the same time, like parts of the market have also been able to restructure their sort of overall finances in ways that they have remained resilient. Now, moving forward, though, I see that the tailwinds are going to sort of start to become headwinds, in the sense that so far, and this is where I'm moving to your question number 2. What are the macroeconomic risks that face today? One of the things that I also want to mention is that we have been, since the Fed started hiking interest rates, bond yield curves inverted. Now, an inverted bond yield curve is never good for overall bank lending, but we have been in this scenario for like more than a year and a half or more at this point, almost close to 2 years actually. In the meantime, we have also been in a scenario where government spending is very, very strong. And it is partially why it is almost kind of offsetting the tightening that the Fed is trying to do, because government spending is essentially adding real economy money into the economy. And at the same time, the Fed is not buying. So the private sector essentially has to absorb it all. And so far, it has done well, more or less. We have not seen major hiccups, with the exception of the SVP crisis or some other mini banking crisis in March this year. But moving forward, I do see some major economic risks forming. Now, are they going to play out in 2024 or 5 or sort of a little bit ahead or down the line is to be seen, because ultimately there are lots of because to give you a context, we all thought that liquidity is going to collapse in 2023, yet it did not. Why? Because government the US government who had to issue debt, they were not issuing debt at the longer end. They were issuing debt on the shorter end. And as a result, the reverse repos were used to absorb it. And when the reverse repos absorb it, it is a net positive for liquidity. And no one almost saw it coming. Everybody was of the opinion that liquidity will go down, which will weigh down on the stock market and all the following steps that happen, and it's going to result in a recession. That did not happen. So as a result, the timing thing is always a little bit difficult to predict. But coming back to the question of macroeconomic risks, on the household front, there is a widening gap between the haves and have-nots at this point. The haves are fine, in my opinion. On the other hand, the have-nots, it's going to start to become a little bit tricky given the state of the growth of credit card debt as a percentage of disposable income. Currently, credit card debt has grown at a really fast rate historically. Credit card debt as a percentage of disposable income is at 8%. So that is actually at the at the GFC level, to be very honest. Now, that does not mean that it's time to panic or whatnot, because the labor market is still strong, so people can still pay those debts ideally. But should the labor market weaken, should interest rates sort of stay as is or move up, then there can be problems in the consumer market, in my opinion. That is macroeconomic risk one on the consumer end, credit card delinquency. On the second part, on the second macroeconomic risk, corporations. Bankruptcies are rising, obviously, but it's also important to note that majority of the S&P 500 companies have actually been pretty fortunate enough to lock in low rates. But moving forward, the longer the Fed keeps rates high, there is a growing chance that there are going to be more bankruptcies coming ahead in terms of especially small caps, junk bonds, corporate REITs, and sort of the opaque space of private credit that exists. That's the second macroeconomic risk, which is bankruptcies at a corporate level. The third macroeconomic risk is obviously banks. And banks so far has been, big banks so far has been okay. They always are okay, pretty much. But an inverted bond yield curve is never too good for the overall bank lending picture. And once again, if credit card delinquencies start, if bankruptcies start to roll in, then obviously banks will start to feel the brunt of it. And banks are raising their credit reserve, the credit reserves. If you look at the latest earnings report, by a lot. And finally, the fourth macroeconomic risk that I see is on the overall liquidity front. And what do I mean by that is that, as I said earlier, that last year we were thinking that there's going to be a liquidity problem this year. It did not happen. Why? Because the government issuing debt, they did not issue the debt on the longer end, they issued debt on the shorter end, which means they used reverse repos to absorb those debts. But reverse repos are almost over. Reverse repos actually are, I think, around like $800 billion from a height of $2.2 trillion. So it's probably a matter of probably months at this point, of quite a few months before reverse repos are over. And when reverse repos are over, then it's going to be the bank reserves that has to soak up the debt at that point. And bank reserves having to soak up government debt is not net positive for liquidity. It is a net negative. And there is obviously the idea of how low can bank reserves even go? Because last time in 2019, when bank reserves fell all the way down to, I think, $2 trillion or $1.9 trillion, there was a reverse repo crisis. And today bank reserves sit around $3.3 trillion. But at the same time, like it can't be just compared to like, oh, so we still have like maybe $1 trillion left. It can't be thought of that, because each time the Fed doubles or ups its balance sheets, or the whole mechanism of the financial plumbing changes. So there is a big question mark around that. It is possible that inflation may come down quite rapidly before that, in the sense which would make it easier for the Fed to stop its bond selling program at that time, its QT program at that time. So by then the Fed would say, we are not selling anymore, we may be accommodating. So there are all these questions that need to be answered. There are still huge question marks down the line. So 4 economic risks: household credit card delinquency, corporates, bankruptcies, banks. Obviously, if credit cards and bankruptcies happen, banks are in trouble. And fourth, liquidity crisis, repo crisis, if the Fed continues to sell its bond, its assets as it plans to, and inflation doesn't come down, so it can reverse its original plan. That's my thought to you.
Okay, so it's interesting because when you talk about the risk, right? I mean, so do you use any metric to gauge the economic risk when you do your macroeconomic analysis?
I'm sure that, if I had a degree in economics or had a PhD in economics or worked in one of the investment banks, I would have like fancy metrics. But to be very honest, I think I sort of like look at maybe at a high level, I look at credit rating. Sovereign credit rating is one. Obviously, individual company credit rating is a second. We know that US credit rating got downgraded in some form
Yeah.
or shape a couple of months ago, I think,
Yes.
by Moody's, and prior to that, it was Fitch. But it's not necessarily a big concern as of now. I think the big major idea at this point for the credit rating downgrade is primarily because of the concern around how much debt the government is issuing, and is there going to be enough demand, to be very honest, given the overall picture of inflation and other macroeconomic factors. So credit rating is one. Credit rating concept can also be applied to companies, obviously. I think the main sort of piece that really speaks to me, I would always say, is the yield curve. I mean, obviously, the yield curve sort of almost tells you right there and then, like, given the current state of interest rates, is there going to be a slowdown? Is there going to be an expansion? Like, what is it that the bond investors are currently pricing in? And obviously, in the bond market meltdown that we saw in September, after the September FOMC was indicative of that. Like, the bond markets were completely chilled out, and then the Fed comes and the Fed says, "Oh, we are going to actually keep rates higher for longer," and the bond market had to reprice the whole situation. It still remained inverted, but the bear steepening sort of spoke to the degree of sell-off we saw in equities, for example. So yield curve, credit rating, credit spreads is a third metric I would use. Currently, on the credit spreads piece, I don't see any sign of stress, though probably credit spreads, when it actually shows signs of stress, it is probably a little too late. But especially on the investment grade side, and also interesting in the junk bond side, you would think that there is going to be some stress, but it is actually very, very, like, it's very flat. There is practically no volatility there. And the fourth piece is, I mean, I don't look at it enough, to be very honest, but I would say, like, foreign exchange risk, to be very honest, like, especially, like, if you're doing like cross currency trades or cross country investments, I think foreign exchange volatility comes into play, for sure. But sort of at a high level, I think these four are my go-tos. I'm sure there are more sophisticated metrics to look out there. I see a bunch of like different technical indicators all the time, but just to sort of keep my objective head in one place, I just refer to these four and stay sane.
I think it makes a lot of sense because in economics, you have everything intertwined, right? I mean, the government or the Fed actually does one thing using these tools, right? Which could be interest rates or any other monetary policy, then it will affect the other variables, right? So I think it makes a lot of sense. So since you brought up inflation, today inflation is slightly higher than 3%, I guess. So when we look at the economic data, right? So let's look at the prices for non-durable goods, which have declined. When we look at the CPI, the latest CPI, right? And on the contrary, the prices for durable goods have actually gone up. And even PPI, when we look at the producer price index, which has also declined. So what do you make of this? What do you think? What's your outlook on the inflation?
Sure. Short term, I think inflation is probably heading down a little bit more. If the current tightening continues, and if we do not get sort of a sudden jump in inflation from some commodity spike or some other unforeseen areas in the economy. Else, I believe that the CPI or overall inflation is ideally going to not surprise on the upside anymore. Having said that, do I believe it will go to 2%? I'm not sure about that. I think this decade has sort of a longer inflation story written to it, and I'll come back to that. Now, yeah, I did look at the CPI report today, and I saw that the CPI CPI services have again ticked up. And I think we just have to kind of agree or come to the point of like realization that no matter how much the Fed is tightening, at the end of the day, consumer spending is remaining strong. And the reason why is because like, and this is where the structural piece comes in, because you have an aging population, you have the boomers at this point, where they have accumulated a ton of assets at this point. Net worth of US at a large scale is at its all-time high at $155 trillion. And once again, it is sort of the people who are in the retirement age and past that who sort of own most of that wealth. And they're going to continue to spend. And no matter how much the lower and the middle income households are suffering because of inflation and interest rates, the average number often does not capture the pockets of the economy that are suffering. Just because the wealthier or the haves are fine and they're spending, I think it sort of like lifts up the overall average. And I think that's probably why CPI, I think, came a little bit higher, led by services. If I look at PCE or core PCE, yeah, I do see trending, sort of the durable goods trending lower. I see non-durable goods trending lower. Interestingly, shelter, which was one of the biggest things, oh my God, shelter has risen so much and all that, all the talk around that. CPI shelter is starting to slow down, which is a good thing. In fact, I think that CPI shelter is probably quite a lagging indicator. I think we are going to probably see more downturn in CPI shelter, especially if you sort of overlay, what you're seeing currently by more sort of up-to-date market metrics that is provided by Zillow or Apartment List. And when you sort of overlay that, you almost see that CPI shelter is a little bit lagging. Not little bit, it is lagging by 6 to 12 months sometimes. So you actually may see CPI shelter continuing to see downward trend, which means that overall CPI will continue to go down. So therefore, my immediate outlook for inflation is that we will continue to see sort of still some more slowing down. And as long as it does not accompany a weakening labor market such that the Fed freaks out, especially since next year is an election year, and lowers the interest rates to spur the next sort of next phase of economic growth. This is sort of my outlook for the moment. I do believe that actually any weakening in the labor market, we will see a slight weakening in the labor market, and the Fed especially will be kind of almost not forced, but kind of influenced to lower rates. And as I said, like there are some very, very strong underlying inflationary forces in the economy as of now. There is obviously the aging population. There is a big giant-sized government spending issue, which is very, very inflationary. There is the whole reshoring part driven by geopolitical tension. So all these pieces, all these like structural forces are very, very inflationary. So my idea is that inflation is, even if it sort of like comes to close to 2.2% and the Fed sort of reacts and lowers interest rates, which it can obviously, yeah, we will see a move up in overall economic activity. Yes, markets are going to cheer soft landing, but not for too long, not for too many quarters, because I think inflation will once again, in much shorter period of time, come to surprise up on the upside. So that's sort of my short-term to long-term idea that inflation is going to remain on the upside, and the Fed has to stay on guards with its interest rate policy in this decade at least.
Okay, so we haven't recovered fully from since the pandemic, right? Supply chains still remain to be severely stressed. So and then obviously the Fed has a target of 2%, right? And we are slightly above 3% today. So how do you think the inflation is going to finally subside? I mean, do you think the Fed is going to start reducing interest rates by early next year? I mean, what's your forecast?
Sure. I think, yeah, the Fed is going to definitely reduce rates. There is no denying it. The Fed themselves think that they're going to reduce it. There are different institutions, analyst groups who think they're going to reduce more or less. I know, like Goldman Sachs, for example, believes that the Fed wouldn't have to necessarily reduce rates as much because we're going to avoid a recession altogether. Whereas if you look at forecasts from, let's say, JP Morgan, they think that the Fed has to reduce rates by, I think, more than like 2.25% or something like that. Yes, the Fed is going to cut rates next year for sure, because the overall demand, the overall labor market, the overall sort of forces that was pushing us up, the same forces are going to push us down. We are sort of in the second phase of tightening, as I'd like to call it. And the Fed is now going to take a chance, because the last thing it wants to do is to keep rates as is and then actually engineer a recession. Like, it already kind of messed up in the first half, in the sense that it was too complacent to raise rates for the longest period of time, thinking that inflation was transitory and whatnot. And yet, when it realized that its thesis is probably a little bit mistaken, it came back with a vengeance. And it didn't have to be this vengeful, because this kind of vengeance ultimately hurts, once again, the lower and middle income people the most, the main street per se. So I think the Feds are not going to wait around and say that, hey, I think inflationary pressures are there in the economy, so I'm going to keep interest rates high. They're not going to say that. As soon as there's any signs of weakening, or most importantly, as soon as reverse repos are done with to soak up the additional government debt issuing, the Fed is probably going to say, you know what, we have conquered inflation from wherever it was to maybe 2.7 or 2.9%. And right now we believe that we have to accommodate back. Because if it doesn't, there's going to be a repo market crisis, and there's going to be a higher likelihood of a repo market crisis, and there's going to be just unwanted circumstances that it doesn't want to deal with, in my opinion.
Yeah, I think it makes a lot of sense. So on one side, we have the Fed that's trying to dampen demand, right? And then we have these constraints on the supply side. And then when we look at the markets have recovered this year so far. If you look at S&P, it's already up by about 20%, while the productivity growth has actually fallen. So what do you make of this? What do you think is more important for the markets? Is it the supply or the demand?
It's a good question. It depends. Obviously, when COVID hit, it was all about pushing up demand to save the economy. But then obviously, if supply cannot catch up to demand, you have inflation. And when you have inflation beyond a certain amount, it's not good for overall investor confidence. It's not good for overall wealth effect. It's just terrible. So it depends which stage of the economic cycle you're in. So obviously, when you're slowing down, if you're sort of reaching recession, or if you're in a recession, obviously demand is important, because at that time there is plenty of capacity out there to absorb the demand. But then with COVID, or during the COVID pandemic, we saw that the governments obviously tried to strike up demand really quickly. It was successful, and then demand came back really fast. And hey, supply is now constrained and tight, and as a result, you have inflation. And then suddenly, people are scrambling to increase the sort of optimize the operating leverage side of things on the supply end. So I think it depends from cycle to cycle, or stage of the cycle to cycle. As for productivity, I think I mean the US has a productivity issue if you look at it sort of structurally, and sort of the big reason probably is that A, aging population, B, population decline, C, lower labor force participation. Especially after the pandemic, labor force participation has still not recovered. So obviously these weighs down on productivity. And will it recover? I don't know. We have not seen the kind of labor force participation we saw in the 80s to now, because just sort of the demographic has shifted in the country. And we see that in all countries, as countries sort of age from different stages in their life cycles. So that's one. But at the same time, productivity can obviously be struck up once again if there is capital spending, if there is well-intentioned capital spending, if AI actually sort of promises to deliver what it delivers. And that part is a huge question mark at this point. I mean, we know the power that AI can unleash, especially on labor markets and whatnot. But so far, I think it's a question of sort of seeing if AI is really going to just sort of benefit the producers of the actual technology who are producing the AI, or is it actually going to seep in through the broader market into like consumer products and things like that? So there is a lot of unanswered questions on AI. I am definitely optimistic about the long-term prospects of AI and what it may mean for the overall productivity boost. I am unsure about what labor market will look like at that time, especially if you see over the last, I think, well, most recently Spotify, but over the last a little bit longer time period, there are companies, especially Klarna, for example, they are laying off a bunch of people. Spotify reduced 17% of its workforce because it believes that it can produce the same amount of output with technology. Like, that's very scary. And that means like the workforce has to like upskill, or what does it mean for the future of labor? Even if, goods or services can be produced at marginal cost of zero. So I think there are lots of unanswered questions, but on the productivity side, yes, we know why it is what it is. It is low because of structural demographic issues, and it can stand to benefit from AI, but the long-term implications of AI are still a big question mark, in my opinion. Yeah.
I know that you're always very optimistic. That's a very optimistic view of the economy. But now, given the industrial production and the manufacturing, which is down, but then on the other economic indicators, we have an improved unemployment and wage data that has recently come out. So do you still see a soft landing, or, because there are a lot of arguments among economists that there's going to be a hard landing. So how do you see this? Are you still hopeful?
Yeah, great question. Do I see a soft landing? Because I'm an optimist. I'm a pragmatic optimist. So I sort of pivot to pessimism as well, if need be. But I like to be optimist because that's how human evolution and progression happens. Now, on the idea of soft landing, like, let's just define what exactly soft landing is. Because, like, what is soft landing? Soft landing is essentially like the idea that Fed will reduce rates just in time when the inflation is reaching 2.2%, so that the next level of economic expansion can happen and everybody's happy and merry and stock markets go up and everybody is just celebrating. That's the idea of soft landing. Now, markets are already pricing in for Fed cuts, and Q3 earnings are over. For next year, earnings are expected to grow 11% for FY 2024. I am pragmatically not very optimistic about that. I think markets are actually overly optimistic for probably no good reason. However, until those results actually come in, until Q1 starts, and Q1 earnings are going to start trickling in probably March or later. And markets in the meantime, though, will have the idea that Feds are going to cut rates, inflation is slowing down, and there is no earnings, and earnings are expected to grow 11.4% or whatnot. So under these mere assumptions itself, markets can do a soft landing. In the sense, markets can reach all-time highs, in my opinion. But will the companies actually realize that? I think there are some major flaws to thinking that 11.4% of earnings growth year over year is attainable. I think when markets do realize that that is not the case, and given what it is pricing today in terms of equity risk premium, there is going to be some significant drawdowns, some significant declines. I don't think a 2008 style crisis or anything of that sort, but there will be drawdowns because of the way that earnings are priced in and given where bond markets are and sort of the overall picture. So soft landing, if it happens, I mean, I think it will happen for the S&P 500 because it sort of lives in its own expectation forecast world. But in the real economy, I'm not certain.
Okay, so right. So with the Fed still being giving a hawkish guidance, right? And then so we have this level of debt for the government in the US. So the government collects about 2.5 trillion in personal income taxes. And then out of that, it pays about 40% of that, which is around $1 trillion. And then obviously it has to refinance this debt, right, at higher interest rates, given the increasing interest rates today. So how sustainable is it, do you think? I mean, because there's a lot of, again, a lot of economists argue that, going at the same pace, especially the Fed increasing its interest rates, it's going to be non-sustainable for the government in near future.
Sure. It's a brilliant question. It's a question I have been scratching my head since I started my Substack or my newsletter, because I'm very fascinated by this. The truth is, it all depends on the inflation picture. Yes, the Fed has raised rates aggressively. The Fed has also sold a bunch of its securities, and it is continuing to do so, which means that the private sector essentially has to absorb it all. When the private sector has to absorb on top of that, if the private sector has to absorb the new issuance that is coming, which is what is happening today, obviously yields on the 10-year goes up. And as that happens, overall financial conditions tighten. It tightens for everybody. It also tightens for the government. And as a result, on top of whatever the government is actually issuing in terms of debt, it has to now pay a higher interest interest on its debt, as you mentioned. Now, unlike you, I, or a corporate, if we cannot pay back our debt, we default, we go bankrupt, it's terrible. But a government, on the other hand, can actually always print more money. Now, how that is actually accepted by the global market depends on multiple factors. Like obviously, the US has not ever defaulted on its debt. It will always continue to raise its debt ceiling for as long as it can in order to pay its debts, in order to pay whatever it needs to. And so that is what is happening in a sense. Like, yes, the debt payments are going up on government debt. And as a result, the government needs to now issue even more debt. So it's like kind of like almost the snowball effect that is happening. And the funny thing is that it's not funny, it's ironical. The ironical thing is that while the Fed is actually using the interest rates to quell inflation by quelling bank lending, the government side of things is actually pushing up inflation, because the governments are also getting affected by high interest rates. The government has to pay more interest on its debt. As a result, it is issuing even more debt. So as a result, it's adding more real economy money into the economy, and it's fueling inflation. So it's almost a tug of war that is happening. So how long is it sustainable? Very good question. It actually depends, I think, on the overall inflation picture. If inflation actually goes down, if we have a 2008 style recession, I don't think it's going to happen. But if that is actually in the cards, given however things manifest themselves, then actually government can continue to issue as much debt as they want. Look at Japan, for example. It has the highest debt to GDP, and the country has been doing that for over 3 decades or something. It is only now that inflation is starting to even become a conversation in that country. So if inflation is low, yes, governments can print as much as they want, in a way, I guess, but there are always risks to that. When inflation starts to be lingering or sort of on top of people's mind, then this sort of then government can still obviously continue to issue more and more debt, and that is in the cards for government spending. Government deficit spending is expected to double by 2033, becoming 7% of GDP. So government is not slowing down its spending because it can't, because if it does, it will have huge political consequences. It is just a question of like how the world sort of views US government credit rating in that case. Are buyers or foreign buyers of US debt still around at that time then? Because, hey, USD is a reserve currency, but if the US government is spending money like what Stanley Druckenmiller, I think, said, like a drunken sailor, then what good is a US dollar versus a Turkish lira? So, I mean, I'm not going that far. I mean, dollar still has huge network effects, but it sort of just brings to the question of like, yeah, how sustainable it is. And it all sort of boils down to, can we keep inflation at 2%? And if not, then there are going to be ramifications for long-term midterm ramifications for the sustainability question of government debt ballooning up like the way it is, and US not necessarily finding enough buyers, if it makes sense.
Okay, so my next question is, why can't the Fed just keeps interest rates at 5 or 6%? Because there are some economists who actually argue that the lower interest rates for more than 2 decades were not normal. So what we are seeing today, which is 5 or 6%, let's say, even if you're predicting that next year the Fed is going to stop increasing interest rates, do you think the Fed is there a likelihood that the Fed is going to keep interest rates at 5 or 6%, which to some is a normal level?
Yeah, it depends, I think. So ultimately, what are interest rates? Interest rates is just a mechanism for the Fed to control for money supply in the economy. And the level of interest rates is actually based on probably two things, in my opinion. One is nominal GDP, and the second is inflation rate. So, for example, if you look back in 2022, inflation or core inflation was, I think, 5.5% at its peak. And the nominal GDP was around like 10% around that level, which means that real GDP was 5.5%. Interest rates at that time was 0%. So obviously that meant that the Fed was extremely behind the curve because, hey, 5.5% inflation rate is not acceptable for price stability in a way. Now, since then, obviously, the Fed has raised rates and all of that stuff. And today, if I look at it, Fed's interest rates is at 5.25 and inflation is around 3.5%. So there is actually a real Fed funds rate of approximately 2%, which means the Fed is technically now tightening the economy. It is actually because the cost of borrowing is 2% over the rate of inflation. Because inflation is still above 3.5%, the Fed believes that it can, with a 5.25% inflation rate, it can bring it down to 2.2%. Now, we also have to understand that as the economy becomes more and more levered, more indebted, there are other factors to consider because it's not as simple as you just raise rates and things sort of correct, because there are other asset classes and your bond yields that are all sort of like all interconnected, all these signs that you have to look out for to make sure you're not breaking something. So taking into all of these things into consideration, the way that I think about it is that if nominal GDP is growing at, let's say, 5%, and nominal GDP is growing at 5%, and core inflation is 3%, so above the Fed's target of 2%, you have a real GDP of 2%. At that point, the Fed might want to keep interest rates above 3%, maybe 4%, depending on how the overall economic conditions, the bond market is responding. But if the nominal GDP is growing, let's say, at 4%, and the inflation is growing at 2%, so it is at Fed's target, and real GDP is still 2%, there is no good reason, though, for the Fed to keep interest rates above 2% because inflation is at 2%. Like, unless there are some major other economic data points that the Fed sees, which is saying that, hey, as soon as you lower interest rates, financial conditions are going to become super loose and there's going to be an inflation spike. If if inflation is at 2% and nominal GDP is at 4%, real GDP at 2%, all things equal, the Fed really has no reason to have a real interest rate above 2% because it does not necessarily need to tighten or expand the economy at that time. It can sort of keep its interest rate at 2%. So it sort of really is a function of where, like, what your economic goals are, where you see the overall economic picture, where you are in the current cycle, and what other sort of data points, such as the yield curves, the credit spreads, and other metrics are telling you. So yeah, it's I think there is no like one and done answer, like, oh, the Fed can keep it at 5 to 6% like it did back in the 1970s or whatnot. Because US was a very different economy then. US was growing fast. It used to manufacture and produce a lot of its goods on its own. Right now, US is a net importer. Is a net importer. So things have, when an economy becomes like so indebted, there are lots of things to take into account when interest rates are rising, and seeing how it sort of affects the different parts of the economy, such that you don't break something because you just don't know how interlinked things are. But to answer your question, it is a function of GDP, nominal GDP, and inflation rate, and depending on what you're seeing, you sort of determine whether you want to push or pull.
Absolutely, I agree with you. I think at these levels, it would be very difficult for the governments to actually sustain their level of debt. Going back to the same question that I asked, right? So I kind of agree with you on this. I think 2 to 3% or 3 to 4%, even 4% would make, I would say, some sense, but then not 5 to 6% or even 7% for that matter. It doesn't make any sense if the inflation is at 2%.
Absolutely.
Yeah. So in one of you've been right about the market so far. I remember reading one of your articles. You said the markets have actually bottomed out, and the bank lending has started loosening again. So when we look at S&P today, so it has recovered since 2020. If you look at S&P's performance, so I think it's up. It has almost doubled. And for this year to date, it's already up by about 20%. So how do you see the capital markets? I mean, do you think this is going to continue?
Yeah, absolutely. I think it sort of ties to your overall question of where I think whether we think we're in a soft landing or not. And the way that I'll answer it is I'll sort of go back to the history very quickly, which is that S&P 500 topped at around 4,800 in January 2022. It struck a bottom as of now at 3,400-ish in October 2022. And since then, obviously, it has recovered, and it is at 4,600 and more today. Now, is it going to continue up from here on? Great question. It is dependent on three things. A, is inflation going to come at or above expectation? B, are earnings going to come at or above expectation? And three, are the overall sort of economic uncertainty, whether we talk about consumer confidence or business sentiment, those things going to become stronger or weaker going forward? So one of the ways that I look at it is I look at these three things through the lens of this thing called ERP, or equity risk premium. Equity risk premium is essentially the additional premium an investor gets for investing in a risk asset above the 10-year US Treasury bond. So if I extend the concept of equity risk premium to understanding what it is that the S&P 500 is currently pricing in terms of its 10-year bond expectation and its expected cash flow, it is currently expected to produce around 8.8% return into the future. You think, okay, but 8.8% is great, but hold on, 8.8% is just the nominal return. You subtract the 10-year from that, 10 years around like 4.2 or whatnot, you have an ERP of 4.5%. So as an investor today, if you invest in the S&P 500, you're essentially making 4.5% higher than what you would make investing in a 10-year treasury bond. So how does 4.5% compare? If you look at sort of the, and this is actually a great work done by someone I regard highly of, Aswad Damodaran. I didn't take any of his classes, but I used to watch his videos and I thought his framework was just so brilliant and so fundamentally driven that I have adopted its mine and sort of play around with it. And I'm talking about it right now with you. So, if you look at the chart, if you look at the history of like ERPs or equity risk premium, is 4.5% too high or too low? It is sort of in between, maybe a little bit on the low end. So equity risk premium was as low as like, I think 2.5 to 3% at the top of the 2000 dot-com bubble bust. So at that time, like equities were overvalued. Everyone was just like thinking that equities are going to run to the sky and whatnot. And if you look at like sort of October 2022 last year, you saw equity risk premium actually go up all the way to around like 6% because people were just like, we were thinking that, oh my God, it's going to drop and whatnot. So it's a lot to do with sentiment. It has also to do with inflation expectation, earnings expectation, and whatnot. So given this, I'm going to overlay sort of the 5 economic scenarios that can play out from here. And I will tell you which one I believe will play out next. But this is sort of how I think about it. The 5 economic scenarios each comes with its set of earnings expectation, inflation expectation, and economic growth expectation. So the 5 economic scenarios, we have the status quo currently. Earnings comes at expectation, economic grows as per Fed, and inflation sort of stays a little bit above Fed's expectation. If I actually translate this to where the fair value of S&P 500 should be, given the current bond yield, S&P 500's fair value actually sort of sits right around here, around 4,600 to 4,800. So actually that means that there is probably around another 1 to 2% move up from here in the status quo. Second, we have productivity acceleration that I call productivity acceleration. In that scenario, we have earnings that grow above expectation, economic growth that sort of comes at expectation, and inflation falls to 2.2%. This is your soft landing scenario. And in that case, S&P 500 will touch 5,000 or more. 3, higher for longer. In this case, we will once again, in the next coming quarters or when not, we will see once again an inflation spike driven whether by commodities or not. And in that case, the Fed will be forced to once again start to raise rates. This will cause the bond markets to once again reassess the whole pricing situation. Economic growth, though, still stays positive. In this case, S&P 500 will fall below 4,000 and it will sort of be around like 3,750-ish, the point where we sort of started 2023 with. These 3 scenarios have economic growth positive. The last 2 scenarios is where economic growth is negative. In that, we have deflation, sort of the 2008 style deflation, where earnings falls. Well, if it is a mild deflation, maybe 7%. If it's a proper 2008 style deflation, it is 15% or 20% earnings drop. We have economic growth, which is obviously negative. Inflation obviously falls. In that case, S&P 500 will fall to around 2,900 as per my calculations. Everyone's estimates and assumptions are a little bit different, but that's my sort of first point. And then the last scenario is stagflationary recession. This is what I think everyone fears the most, which is where you have earnings that come under expectation. You have economic growth that slips into recession, yet you have inflation that is still not at 2.2%. It is still higher, like where it is currently, and it's not necessarily trending lower. That sort of like that's sort of the horror situation for the overall US equity market and sort of the future outlook for, is this the end of the bull market and whatnot, all the doomsday scenario that happens. In that scenario, obviously the low How low it can go, nobody knows. But once again, if I do the calculations, based on my calculations, it's around 2,750 as a first stop. So 5 scenarios, status quo, nothing changes. S&P 500 can easily is completely fine to hang around here to 4,800. From here onwards, productivity acceleration goes up to 5,000. Higher for longer, 3,700. Deflation, 2,900. Stagflation, just pack up and go home. So you have these 5 things. Where do I see things playing out as Q3? As I said earlier, like Q3, as I said earlier, like Q3 earnings are over. Q4 is coming up later. In the meantime, markets are pricing in 11.4% growth. There is no reason now, between now and the next earnings call, for markets to necessarily change their mind, because unless companies actually come out and say point blank that, hey guys, we have to reduce our estimates. So as a result, as I said, like the soft landing can be manifested in the S&P 500, whereas actually in reality it may not be. So as a result, I actually think that markets can possibly reach new highs. I do not think 5,000 though. I do think between now and till whenever, until the next earnings call, markets kind of have a free pass to claim its all-time high from 2022 January. But if you look at it with perspective though, 2022, 2024, 2 years have gone by and markets actually just probably made 1 to 2% move up from its high to high. Meanwhile, inflation is like on a year-over-year basis, probably I don't know on top of my head. So technically, all things equal, S&P 500 will still be yielding negative real returns over a 2-year period. So that's where I think S&P 500 has no reason to stop at this point until an earnings call actually resets expectation that earnings are not going to grow 11.4%, which I think is the case. But markets can have their own version of soft landing while it may not happen in real life. So that's my take.
Yeah, I think I kind of agree because we have seen the repercussions of increasing interest rates, right? It seems like the Fed has also been a little careful in giving its guidance, right?
Absolutely.
And your prediction that the Fed is going to slow down next year, we have seen some of the banks with high loan to deposit ratios, and then with their customers not being able to actually afford high interest rates, or the installments rather, and defaulting on that front. So the non-performing loans for some of these banks had actually gone up. And then there were a lot of other banks failing. We saw a Silicon Valley Bank, First Republic Bank, where their proprietary deposits tied up to these long-term securities or the bonds, right? And then, some of the banks actually using accounting methods today, not marking their proprietary book to market, which is why they've been able to, sustain, but artificially. And then with Bank of America, when we look at its proprietary deposits, which are invested in long-term securities, actually sitting at 130 billion loss. I think JP Morgan sitting at 40 billion loss. Collectively, I think some of the major banks sitting at about 650 billion loss. So that's the kind of impact we can see if the Fed doesn't stop here and keeps increasing interest rates. I kind of agree with you on that. So I think when some of the economists were predicting that this is going to be the 1970s again, with inflation reaching at about 14%, and then the interest rates reaching at about 14%, and then the inflation going higher than 20%. But I think I think the Fed is kind of done with that. It's been able to actually control inflation, bringing it down from some 8% to slightly over 3% today. So I don't think we're going to be seeing that kind of situation again, what we saw in the 1970s. So I kind of agree with you on that front.
Yeah.
So now I know you have written extensively about the investments being made in defense sector. So now let's switch to the geopolitical situation, since we are talking about inflation, right? let's say if the Fed stops increasing interest rates, let's say early next year, and then we have this geopolitical situation. We have a war in the Middle East, right, with Israel against Hamas, right? So what if things get escalated again, and then we see a spike, in energy prices? So what's going to be the likelihood scenario in a situation like that? Let's say things getting out of hands, putting more pressure on supply chains. What's the likelihood of seeing a situation like that?
I think no, that's a very good question, and it's very sort of urgent at this point in time. I mean, we are currently sort of in a middle of, I mean, what, like since like 20, obviously sort of the geopolitical situation, the tensions around geopolitics has been getting more and more chaotic. And over the last 2 years, we have now seen two official wars break out. And there are more conflicts, obviously, regional conflicts and whatnot. I think it poses sort of like deep existential questions about sure, the energy market is one of them, but broadly sort of like, what do you invest in this kind of a market? Right. So, I mean, I'll maybe talk about the energy part first, because obviously, like if I look at the energy market, oil, if I look at the spot price, it was up, I think, some 22% in September, up until September, and now it's down 9% for the year. So, some huge volatility in oil prices. And if I look at, I also looked at what IEA had said in July of this year, and it had said that the bullish case for oil remains because of three things. A, it believes that the macroeconomic demand for oil is going to remain strong, as it believes that China is going to come out of its misery pretty quickly. The second piece it mentioned was that OPEC Plus will continue to restrict its oil production quotas. And the third thing it had mentioned was that geopolitical tensions are going to continue to be chaotic. Here we are in December, and we have seen that on the macroeconomic front, China is still kind of lagging. We have not fully yet seen China come back in full force. On the OPEC front, we have seen that Saudi Arabia has cut about $1 billion worth of oil barrels worth of production back. Russia has done the same, and geopolitical tensions have continued to worsen. When I look at sort of the longer term picture of this, I would also like to point out that, like today, for example, the strategic reserves in the US probably sit around like 350 million. There is a political mandate to fill it up to its prior levels, which is so 350 million is actually 44% from its peak. So next year is election year, and there's a political mandate almost to fill it up to its prior levels. And as far as I understand, the price that they're willing to fill it up at is between like sort of where WTI is currently sitting all the way up to $80. And in the meantime, you look at like the US consumption, the US is consuming around like $20 million barrels a day. So just like looking at the US picture specifically, I would say that the case for oil is short-term bullish, because the SPR reserves are going to fill up. US demand, depending on where it is currently or where it goes up slightly. So I do see the bullish case for oil. In the meantime, one of the other things that to note, obviously, is that when it comes to OPEC, their break-even price is around like, I think, for the GCC countries, it's around $80 to $85. So there is an actual reason for them to continue to cut production to meet, so that they're profitable at the end of the day at $80 to $85. So long term, yes, I think unless we have a proper recession, and to accompany that there is a war, which is just which can happen, but let's not take that case into assumption. Let's let's just think that from here we are going to see like status quo. We're going to see China's demand come back up. We may see a broader slowdown in the US economy, but it's not going to reach like 2008 financial crisis level. We're going to see geopolitical tensions remain as is or escalate. And given that there is sort of like almost more than a decade long, if not more, in my opinion, of underinvestment in oil, there is an actual bull case for oil where I see like energy prices going up. Now, I mean, I know a lot of oil analysts come and say, "Oh, oil prices are going to be $200 and whatnot." I'm not like I wouldn't be so confident as to say that, to be very honest. But I do see a bull case for oil. Now, having said that, that's just on the oil front, and I think oil is definitely depending. I know there's often a lot of backlash for oil for an environmental standpoint and whatnot. But at the end of the day, an investment is an investment, and an investment is designed to generate returns. And oil drives the economy just like data does. So at the end of the day, therefore, the case for oil remains. And there are different ways to. I am invested in oil, absolutely. I'm not. I don't have a majority of my portfolio in oil, but I'm invested in oil. And the way that I invest is through USO, which actually invests in the spot price of WTI. But that is primarily because I understand the WTI or the spot price aspect of oil. There are other ways to invest in oil. For example, you can invest in the ETF called XLE, or which invests in oil production companies like Exxon and whatnot, or you can invest in individual stocks. So it ultimately depends on how much of an effort you want to go to understand each of the company's balance sheets and whatnot to actually invest in individual companies versus sort of taking an easier path with lesser risk and equally good returns. So that's sort of the case for oil. And I think, yes, the case for oil is there no matter whether we see a mini recession or sort of the broader spectrum remains for oil. Now, in terms of the broader investment themes, therefore, for this decade, as you mentioned, like defense tech, yes, I do talk about defense tech. Defense tech was probably quite like quiet for the longest time after the GFC era. That's because like US was recovering. It had already spent a bunch on wars in Iraq and whatnot, and it was just in the process of like consolidation. However, if you look at the projections for budget deficit, the military spending projections for the US is expected to grow its military spending by 3.6% every year for the next 10 years. This is the first time that US defense spending is going to grow for a whole decade since the Iraq war took place. So this obviously brings the question of, okay, like, so then we are talking about that, defense spending going up. There's going to be more focus on like in production for military products. Which companies stand to benefit? How does US sort of like sit at the intersection of like market share of global military export orders, and what are the companies that benefit? And yes, US is the largest share US has the largest market share of exports. It has in fact grown its market share from 33% to 40% in 5 years, from 2017 to 2022. I think it has 60% of the largest military companies, which are US companies. And if I look at sort of the backlog of orders, which is one of the biggest metric to look for when you're looking for investments in defense tech, because they are not going to be able to like give you the equipment right away. They will take their time to produce it. It sometimes takes 6 months, sometimes it takes them a year or so to like actually give you, deliver all the stuff to you as per the requirement. If you look at the backlog orders of companies such as Lockheed Martin or Raytheon, or a much more sort of niche play called AeroVironment, which is a newer company in this space, it is accelerating. And that is a terrific sign of revenue actually growing down the line. And revenue is accelerating. These companies are not trading at very high valuations, with the exception of AeroVironment, that is trading at a higher valuation. But relatively speaking, backlog is a big indicator and it is growing, which is a good sign. These companies are managing their balance sheets pretty well, with operating margins at around like 15 to 18%. They're free cash flow positive. It is not a crowded trade. And interestingly, hedge funds and VC firms are increasingly investing in the overall defense tech space, if you look at like their overall count of AI deals, that has gone down. I don't want that to happen long term, but regardless, it has gone down year over year. However, if you look at the defense tech investments, that has actually continued to go up on a year over year basis, which is kind of interesting. But at the end of the day, depending on your overall investment ideology and principles, I think defense tech is one of the lesser crowded trades that stands to benefit hugely in the coming decade.
Yeah, I think so. The large corporations do not really have a huge impact on their balance sheets because of high interest rates, right? It's because they're earning a risk-free rate on bonds and short-term bonds and treasuries, right? And paying a lower rate on their debt. So which is a very big advantage. But so far, when we talk about liquidity, so the liquidity has improved because of the private sector investing, in repos, like you said. But then the equity risk premium still seems to be slightly lower. It's just because the risk-free rate for short-term treasuries is higher, right? So now it's good that you brought up as to where the funds are flowing, right? Where the investments are being made, which is defense sector being one of the industries, right? Now, so what do you think about other countries like China? We also have India, we have Japan. So, given the advantage of currency. Now, I do understand that there are structural challenges or disadvantages for investors. But don't you think, the investor should be looking at these countries now where when we look at China, the interest rates, in fact, the Chinese government being one party rule in China, which is the Communist Party, right? I mean, although people complain about it, but I think they have been able to control inflation for their citizens. They've been able to keep the interest rates low. So I know for a fact that a lot of investors like George Soros has an exposure in India. Warren Buffett has been investing in China, and so is Ray Dalio. So don't you think the investor should be looking at these markets now, given the situation in the US, which is pretty tight for a lot of investors?
Yeah, you brought a fantastic point. I think emerging market has definitely a big part to play. Actually, when I covered sort of the defense tech, I did not cover all the possible investment ideas. So that I have in terms of, what else can investors invest in other than defense tech and oil. But yes, EM or emerging markets, broadly speaking, is definitely an area of interest because a lot of these countries are actually growing at a much faster rate than the US. And especially if inflation has indeed peaked and interest rates have indeed peaked, that means US dollar will also start to fall from current levels. And a falling USD is usually beneficial for emerging market economies, in the sense that obviously these countries tend to be like commodity producers and so on and so forth. Like India is a little bit different, obviously, because it has a huge service sector as well. But in the so coming back to your point, so like if inflation has inflation has indeed peaked, interest rates are sort of going down, though above pre-pandemic levels or above GFC levels, dollar has peaked. So we are sort of, out of the 5 scenarios, and bringing it up once again, we have the status quo, we have productivity acceleration, higher for longer, deflation, and stagflation. In status quo, I think emerging markets definitely have a part to play. In productivity acceleration, I think emerging markets will probably may outperform the US markets. I'm probably getting ahead of myself, but EM can definitely outperform here, unless sort of the macroeconomic picture in India or China or other EM markets like dramatically change or something. In higher for longer, if once again the Fed has to raise interest rates because there is an inflation spike, and I think that is very much in the cards down the line, unfortunately, EM will once again take a backseat because once again interest rates are rising in the US. With the deflation, it's really not my base case at all. But a deflation, everyone sort of loses for the time being. So let's forget about that. And in stagflation, in which case we have the US economy, which is in negative growth territory and inflation is rising, the Fed's hands are going to be like super tied, tied together in a way that it has never almost ever been before. So at that time, people will be actually looking for safe haven, such as gold, Bitcoin, and possibly EM markets as well. So actually, out of the 5 scenarios that I talk about, like I think in this coming decade, there is a huge part to play for gold, for Bitcoin, for emerging markets, for defense tech, and sort of other defensives in place, given sort of the structural trends that the market in the US is going through, given like sort of the US aging population. So like more around like healthcare or like medical devices companies and things like that. But to answer your question, yes, EM I think is well positioned to deliver in certain scenarios. If you ask me, currently, I am not heavily invested in EM, primarily because I think, like, if I look at history, obviously, for example, India, for example, has Indian market is creating new all-time highs. Its valuation is extended relative to history, but it has a point in the sense that it is growing rapidly. It is gaining investor confidence, and it may start to like create an alternate sort of this new world where Indian equity valuations may not go back to history. So for me personally, that is an area of market that I have to study a little bit more to make an informed decision. But overall, I am hugely bullish gold and Bitcoin in this decade, along with selective picks on long duration and short duration bonds.
It's interesting that you brought up Bitcoin and gold. Although I didn't intend to ask this question, but I still want to ask you. So where do you see gold, and how do you see Bitcoin playing out, given the number of frauds, especially now Binance, right? So before that it was FTX. So and gold, on the other hand, is actually trading at its highest. It's at its peak, right? Now, obviously, that is because of the high rate of inflation. Usually, when the inflation is high, gold is considered as a hedge against inflation, right? So you have most of the governments holding gold. It has its own reasons, I think, which is justified. I'm talking about the price for gold. So where do you see gold as a commodity, and where do you see Bitcoin? How do you see the future for Bitcoin?
Sure. Absolutely. So with gold, yes, it is at its all-time high. It is up, like 10 or 11% this year. Gold is also being, so central banks around the world are also buying gold. Now, I'll again come back to the 5 scenarios. If inflation has indeed peaked and interest rates have peaked from current levels, but most importantly, if real interest rates have peaked and are going to sort of stay here and move down, then it is a fantastic case for gold. So actually, higher for longer, the scenario, my 3rd scenario, where inflation again starts to come back up. If real rates actually start to again come back up along with it, not just the break-even inflation, but the real rates, gold might again sort of like waver a little bit. But in all the other sort of 4 scenarios over here, status quo, productivity acceleration, deflation, and stagflation, I see gold has tremendous upside from current levels. Obviously, gold has a history as a hedge against inflation. So one of the other things to consider, the central banks buying gold is also sort of a broader signal that central banks are sort of, adjusting their balance sheets accordingly to like, make sure that they are well protected and well hedged in case some sort of broader event happens, which is not going to be good. But most importantly, I think the case for both gold and Bitcoin is Bitcoin, on the other hand, is slightly different. Bitcoin has just about a 15-year-old history. It is very different. Like gold has been used as, since ancient times, pretty much. We only moved to the fiat currency so recently because obviously gold is not easily divisible. It is not obviously, it's a physical asset at the end of the day, but obviously, gold has its ultimate form of currency values as a store of, as a unit of account, as a store of wealth, and mechanism to transact with each other. So on that front, therefore, I think macroeconomically gold makes sense. Second, as I said, this decade is going to be nuanced in the sense that there is always going to be this broader inflation lingering fear, given the current pace of government spending, given the current sort of aging population, given the reshoring aspect that, bringing back manufacturing and what inflation and that technically is inflationary, geopolitical tensions and whatnot. People are starting to maybe come to terms with the fact that, hey, inflation is not going to go back down to its post-GFC era. USD, while it is going to be the reserve currency for the time being, or for some amount of foreseeable future, may be coming into question. And as a result, they need to protect their wealth in some sort of a safe haven. And gold is therefore one of the reasons, one of the main mechanisms to do that. And as a result, I see gold having tremendous potential. Now, obviously, I remember some other Substack writers had written about it, I think like last week. If gold has to reach some incredible level of I don't know, maybe 3,000 or some crazy level up, what does it actually mean for the overall economy? That means the overall economy is probably not doing that well, that people are all piling into gold. So having a bullish outlook on gold has sort of a bright and a dark side to it at the same time. I'm heavily overweight on gold, primarily because I see the upside in it, without necessarily thinking about the broader reserve currency mess and all that. Bitcoin is very similar. Now, as I said earlier, just a few minutes ago, Bitcoin does not have that history as gold. Bitcoin is a 15-year-old technology. As you said, there are lots of issues with Bitcoin in terms of exchanges and whatnot that have increasingly had fraudulent activities. I don't think that actually hurts the underlying technology of Bitcoin, which I think is just a better form of gold in a sense. It still has to prove its worth over the course of time. It still has to endure all the volatility. I can't just naively say it is as good as gold, because it doesn't have that history, but it can. I think it has all the characteristics to do so, with its scarcity, 21 million coins, I believe, that ever is going to be released. And on top of that, which gold does not have, it is easily divisible. There's the whole transaction process can be easily tracked in a distributed ledger, which is absolutely not possible with gold, is possible with Bitcoin. So obviously, these are things that make Bitcoin a very interesting investment. There's a ton of volatility. I also would like to add that Bitcoin's correlation with NASDAQ has been sort of has been wearing off, in the sense that earlier, or if you remember, in 2020, 2021, there was a crazy rush for Bitcoin, crypto, NFTs. There was the whole sort of the mania that was happening. And Bitcoin had reached some crazy levels, I think at $70,000, maybe more. And there was a lot of hype at that time. Obviously, interest rates were zero as well. So it's just about so it's just about when the hype sort of fades, is the currency or is the technology still going to be able to endure the longer term trends? And I think it's something that should be part of everyone's portfolio, depending on your volatility. So as I said earlier, NASDAQ's correlation is going down. Currently, we have seen that though interest rates have gone up, bond yields went up this year tremendously. Bitcoin also had a run. So it's very contrary to what people were thinking before, that, oh my God, if interest rates go up, then Bitcoin is going to fall. Didn't happen. Ultimately, people almost saw it as a kind of a gold. Should they? Will Bitcoin fail in the long term? I don't have answers to any of that. But I think the underlying value of the technology is there. One should have a portion depending on their risk profile, and that's my take on gold and Bitcoin.
Yeah, I think I agree with you on this front. So the gold does have a historical value, and but Bitcoin doesn't have acceptance yet from most governments, right? It's still evolving, so we are yet to see how it's going to play out. And with so much of uncertainty, it's not even regulated yet. While some of the ETFs have been approved by the regulators, but it's at a nascent stage, I would say. It's yet to evolve. I'm bullish on blockchain technology, blockchain and AI, though. This that shows a lot of promise. And I know for a fact with this whole metaverse, with all the investments going in metaverse, not just by Meta, but most governments and some of the largest corporations, be it Microsoft, Qualcomm, or any other company, actually investing heavily in metaverse. So I think that has a very bright future, the way I see it. When I look at the technology, the way it's evolving, right, the way it's making progress, I think it's going to be some $8 to $13 trillion industry in the next decade. So, but Bitcoin, uh, being equated to gold, being equated to currency, even in gold, actually, because it's touched its peak, it's trading at more than $2,000 per ounce today. I think one has to be a little careful now with inflation being subsided, right? Being under control to quite an extent. So I think the investors have to be cautious, even investing in gold. I mean, I personally prefer physical gold, or even investing in a fund that's backed by physical gold, where you have the gold holding by these funds, right, as its underlying asset. So this brings us to the end of this session. I thoroughly enjoyed our conversation. Thank you so much, Amrita, for taking the time out and sharing your perspective, some valuable insights. I'm sure this is, the investors or anyone viewing this program is going to benefit to a large extent. So tell me, if the investors or our viewers, if they want to find you, where they can find you, and if they want to sign up for your newsletter. So how can they find you on Substack?
Sure. I think if they go to the Pragmatic Optimist, they can obviously subscribe. I'm always looking to grow and welcome more subscribers. I'm also there on LinkedIn. These are the two main channels. I'm yet to grow on Twitter a little bit more, but LinkedIn and Pragmatic Optimist signups always welcome as I grow my base in Substack and figure out the next steps.
Okay, I wish you good luck.
Thank
So
you.
thank you so much once again, and hopefully I'll talk to you soon again.
Absolutely. Had a great time. Thanks.
Thank you, Amrita. Bye for now.
Bye.
Bye.